Welcome to Bull Bear Dividend Daily. We bring you the latest dividend stock news, smart passive income strategies, and daily market insights to help you grow wealth and earn income for life. One dividend at a time. Subscribe and invest smarter.
The stock market is about to go insane. We're talking massive moves, unexpected shocks, and once-in-a-decade opportunities. Whether you're an investor, trader, or just stock curious, what's coming could change everything. The stock market is about to go insane. Here's why. 1. The current build-up. Inflation is cooling but not gone. So, inflation hasn't disappeared, but it's no longer at the extreme levels we saw during recent economic shocks like COVID-19, supply chain problems, or the energy crisis caused by war, e.g., Russia-Ukraine. A quick recap. What is inflation? Inflation is the rate at which prices increase over time. If inflation is 2% per year, things cost a little more each year. 8% per year, prices jump fast. Your money buys less. Central banks like the Federal Reserve, US, or National Bank of Cambodia try to keep inflation under control, usually around 2% per year. Why was inflation so high recently? Here's what caused the spike in inflation: 2021-2023, COVID-19 pandemic, shutdowns created supply shortages, government stimulus, trillions in aid increased consumer demand, supply chain disruptions, ports closed, factories delayed, Russia-Ukraine war spiked oil, gas, and food prices, labor shortages, wages rose, which added to business costs. Why is inflation cooling now? As of 2024-2025, inflation has cooled because interest rate hikes, central banks raised rates to slow spending, supply chains recovered, goods move more freely now, energy prices dropped, oil and gas prices normalized, consumer demand slowed, people are more cautious with money. Base effects. Compared to very high past prices, the new increases seem smaller. Current situation, mid-2025, inflation in the US, EU, and other countries is around 3 to 4%, down from peaks of 7 to 9%. Some things are even getting cheaper, e.g. used cars, shipping costs, but key costs like rent, insurance, and food are still high or rising. Why it's not gone yet: sticky inflation, some prices, like housing or services, don't drop easily, wages rising, labor costs keep prices high in some industries, geopolitical risks, wars, sanctions, or trade tensions can raise prices again, climate shocks, droughts, floods can increase food and energy costs. What it means for you? Good news. You're less likely to see massive price jumps month to month. Central banks may pause or lower interest rates soon. Still a challenge. Things are still more expensive than 2-3 years ago. Your money has less power compared to before inflation spiked. Investors and market view investors watch inflation closely. Cooling inflation usually means lower interest rates in future. Stocks go up, bonds become more attractive. But if inflation comes back suddenly, markets may drop. What's next? Economists expect inflation to stay around 2.5 to 3.5% in 2025, central banks to be cautious before cutting rates too fast. If global events stay stable, inflation could settle back to normal levels by 2026. Summary: inflation is cooling but not gone means the worst is over. But we're not back to pre-2020 normal. Prices are still rising, just more slowly. We're in a transition period, not a full recovery yet. What is the Fed? The Fed refers to the Federal Reserve, the central bank of the United States. Its job is to keep inflation low, target to 2%, support maximum employment, promote a stable financial system, its most powerful tool, interest rates, specifically the federal funds rate, which influences borrowing costs across the economy. Why did the Fed raise rates in the first place? From 2022 through 2023, inflation surged to 40-year highs, driven by pandemic supply chain chaos, stimulus money, high demand, war-driven energy shocks, so the Fed fought back by raising rates from near 0% to over 5%, making loans, mortgages, and credit cards more expensive, slowing spending and business investment. This strategy worked, inflation cooled, but at the cost of slower growth and higher borrowing costs. What does hinting at rate cuts mean? The Fed isn't directly saying, we will cut rates on this date. Instead, they're using careful language like, we're making progress on inflation. Policy is sufficiently restrictive. Cuts are possible later this year. This is called forward guidance, and markets pay very close attention. But the timeline is foggy. That means the Fed hasn't committed to when cuts will come. It depends on future data, especially inflation reports, job numbers, wage growth, global risks, e.g. oil, wars, trade. In other words, the Fed is saying maybe soon, but not right now. What are the Fed's current challenges? Inflation is cooling, but still above 2%. Jobs market remains strong, which could keep inflation sticky. Cutting too early risks inflation coming back. Cutting too late could slow the economy too much. So the Fed is waiting for a Goldilocks moment. Not too hot, not too cold. What do markets think? As of mid-2025, markets expect at least 1 to 2 rate cuts by the end of the year, but traders are uncertain. If inflation data stays high, the Fed may delay. This uncertainty causes volatility in stocks, bonds, real estate, cryptos. Why rate cuts matter to you. If the Fed cuts rates, mortgages may get cheaper, loan and credit card interest may drop, stocks often go up, savings accounts may earn less, the US dollar may weaken. If you're an investor, borrower, or business owner, rate cuts change everything. What's next? Possible scenarios. Scenario description: Fed. Response: inflation drops fast, economy slows. Inflation below 2.5% cuts sooner. Q3, Q4 2025. Inflation stays sticky. Wages rise. Serve longer. Maybe early 2026 recession risk rises. Jobs fall. Spending weakens. Emergency cuts. Inflation comes back. Energy spike. War. Surprise demand. No cuts. Maybe raise again. Summary: the Fed is preparing to cut interest rates, but they haven't said when. The economy is in a grey zone, strong but not perfect. Investors, economists, and businesses are watching every speech, chart, and data point. Tech stocks are hitting new all-time highs. What it means, why it's happening, and what it means for investors, the economy, and the future. What are tech stocks? Tech stocks are shares of companies in the technology sector, including software, Microsoft, Adobe, hardware, Apple, Nvidia, internet services, Google, Alphabet, Meta, e-commerce, Amazon, AI and semiconductors, Nvidia, AMD, cloud computing, fintech, cybersecurity, and more. These companies drive innovation and have become the most valuable in the global economy. What does new all-time highs mean? It means the stock prices of many major tech companies have never been higher. Some companies like Nvidia, Microsoft, Apple are breaking records in terms of market value, trillions of dollars, share price, revenue, and profit. This typically reflects strong investor confidence and high expectations for future growth. Why are tech stocks hitting all-time highs in 2025? 1. AI boom companies like Nvidia, AMD, Microsoft, and Google are leading the AI revolution. Demand for chips, data centers, cloud services, and AI tools is exploding. 2. Strong earnings. Many tech firms have reported record revenue and profit. Their business models are high margin and scalable, especially with AI. 3. Productivity trends. AI and automation are helping businesses become more efficient, fueling optimism. Tech firms are central to this trend. 4. Interest rate optimism. With inflation cooling, investors believe the Fed may cut interest rates. Lower interest rates make growth stocks, like tech, more attractive. 5. Global digital shift. More economies and industries are moving online. Tech is not just a sector, it's becoming infrastructure for every business. Biggest winners, 2025 highlights. Here are some tech stocks leading the charge. Company recent performance. Why? Nvidia over plus 250% in 2 years. AI chip leader. Huge demand. Microsoft new highs. Dominating cloud and AI. Apple recovered and rising. New products. Ecosystem power. Amazon surging cloud growth. Retail recovery. Meta. Facebook. Strong rebound. AI. Ads. Cost cutting. Google. Alphabet up significantly. Search plus cloud plus AI market. Tech-heavy indexes like the Nasdaq and S&P 500 are hitting highs. The top 7-10 tech giants are driving most of the market's gains, called the Magnificent Seven. These stocks now make up a large portion of global market value. Are there risks? Yes. While optimism is high, there are potential risks. Valuation concerns. Many tech stocks are trading at very high price-to-earnings ratios. Regulation. Governments are increasing scrutiny on AI, data, privacy, and monopolies. Geopolitical risks, US-China tech tensions, chip supply chains, bubble fears. Some fear we're in an AI hype bubble like the 1999 dot-com era. What it means for investors, positives, momentum is strong AI, and cloud trends are long-term. Tech dominates market returns. Caution, don't chase hype blindly. Diversify, don't go all in on one stock. Watch earnings and fundamentals. Next. Bullish case. Continued growth from AI, automation, and cloud rate cuts boost growth stocks even more. Tech stays the core of economic transformation. Bearish case. High valuations, plus disappointing earnings. Sell off. If AI hype slows, stocks could drop, regulation or tax changes could hurt profits. Summary, tech stocks are hitting all-time highs means massive optimism around AI and innovation. Big tech is dominating markets, but the higher they go, the more carefully investors need to watch. We're in a new tech-driven era, but it's not without risks. To the surface. This expression means that conflict, instability, or rivalries between countries are building quietly, and while it might not be dominating headlines every day, the risk is very real and could explode at any moment. Let's break it down. What are geopolitical tensions? Geopolitical tensions are conflicts or rival nations due to military threats, economic disputes, territory, trade routes, alliances. These tensions can lead to wars, sanctions, supply chain disruptions, global market crashes. What does bubbling under the surface mean? It means the tension isn't erupting right now, but it could at any moment. Think of it like a volcano with smoke. Quiet, but dangerous. These issues aren't solved, just temporarily quiet or being managed carefully. Key geopolitical flashpoints in 2025 versus US-China rivalry. Competition in technology, AI, chips, trade, military, and influence Taiwan remains a major flashpoint. China sees it as theirs, the US promises to protect it, ongoing restrictions on chip exports, espionage concerns, and cyber warfare. Russia and Ukraine war ongoing conflict still disrupts global energy, food, and security. NATO is deeply involved through support, but not direct war. The war has reshaped Europe and reset global alliances. Israel and Middle East conflicts, Gaza and regional instability, Iran, Lebanon, Syria, risks of escalation into a broader regional war involving the US and Iran oil market shock risk if it spills over into the Gulf. North Korea continues testing missiles and threatening South Korea, Japan, and US allies. Nuclear threat remains a global concern. India's rising superpower. Border tensions with China, increasing influence in global trade, tech, and security. Why it matters to the economy and markets. Geopolitical instability can drive oil prices higher if supply is disrupted. Middle East. Disrupt global supply chains, e.g. Taiwan chip production, shake investor confidence, stock markets drop on fear, increase military spending, inflation, and national debt. Push countries toward deglobalization or economic blocks. Examples: war, higher food and energy prices, inflation, sanctions, wars, block trade routes, shortage of goods, military conflict, Nesoric, stock market crash, investor panic. Why under the surface is scary. The public may not feel it daily, but intelligence and military analysts are watching closely. One misstep, accident, or provocation could trigger escalation. Diplomatic talks help, but trust is fragile. What can be done? Diversify global trade to reduce reliance on one region, diplomatic pressure and alliances, e.g. NATO, Quad, energy independence to reduce oil shock risk, cybersecurity investment, careful foreign policy and deterrence. Summary: geopolitical tensions, yeah, they're bubbling under the surface, means the world is quietly unstable in many regions. Major powers are competing, not always with bullets, but with trade, tech and influence. Things may seem calm until they're not, like a volcano, quiet today, but tomorrow could erupt. The stock market is about to go insane. The stock market is standing on the edge of something huge. Some say it's the calm before the storm. Others say we're at the beginning of a historic bull run. But one thing's clear, the market is about to go insane. In this video, I'll break down why this shift is happening, what sectors could explode, which ones might crash, and how you can prepare, whether you're trading daily or building long-term wealth. Let's dive in. Cut to high energy montage, breaking news, Fed speeches, stock charts, rising, falling, headlines like rate cuts coming, AI boom, global instability. First, let's understand the landscape. The S&P 500 is near record highs. The Nasdaq is being driven by a handful of mega-cap tech stocks. Retail investors are back, but smarter. They're more cautious than the 2021 frenzy. Bond yields are still high, but trending down. Here's what this tells us. Investors expect a pivot. But from what and into what? That's the question. 5 forces driving the coming insanity. There are 5 major forces putting pressure on the market, and they could erupt all at once. The Federal Reserve. Will they cut rates? When? How much? Watch Jerome Powell's next statement like a hawk. Markets are pricing in 3 cuts in the next 12 months. Could be more or fewer. Artificial intelligence hype AI is not a bubble. Yet. But valuations are stretched. Nvidia, AMD, Microsoft, all riding the wave. Will profits justify the hype? Geopolitical risk. China, Taiwan, Ukraine, and the Middle East. Any escalation, market tremble. Defense stocks could spike. Election year volatility, US. Historically, markets get bumpy during election years. Policy promises versus market reaction. Retail FOMO and institutional rotation. Retail is chasing tech. Institutions are slowly rotating into energy, industrials, and value plays. 3. Sector breakdown. Who's hot, who's not. Let's break it down by sector because not every part of the market will go crazy the same way. Tech and AI dominated by Nvidia, Apple, Microsoft. AI demand is real, but valuations are extreme. Watch for pullbacks and buy the dip opportunities. Financials banks are recovering from last year's fear, rising margins if rates drop, but beware of credit risk. Healthcare stable in downturns. Some biotech names are heating up again. Aging populations, so found long-term upside. Energy oil is volatile. OPEC plays a huge role. Clean energy stocks may rally if the policy shifts. Real estate crushed by high interest rates could rebound hard if cuts come fast. Watch REITs. Consumer discretionary versus staples discretionary is up if the economy grows. Staples are safer plays. Think Coca-Cola, Procter & Gamble. Macro history repeats, lessons from the past. Let's zoom out and take a historical lens. What happened the last time we had high inflation followed by rate cuts? 1970s and 1980s Fed over-tightened, recession, rapid rate cuts, boom, markets surged once the Fed pivoted. 2008 crisis and aftermath crash. Then QE, then a decade-long bull run. COVID-19 crash 2020, massive sell-off. Then insane recovery, faster than anyone expected. Today, we might be at a similar turning point. History doesn't repeat, but it rhymes. Section 5, what smart investors are doing now. So how are smart investors positioning themselves right now? Hedging risk options, cash positions, gold, defensive sectors, buying quality profitable companies with strong balance sheets, not chasing hype blindly, watching the Fed every rate decision, every word from Powell, just a trading signal, looking for rotation from growth to value, from US to emerging markets, being patient volatility, just opportunity. Not every stock will survive the chaos. Section 6, what to watch next, key events. Now, here's a checklist of events that could trigger the market madness. Next CPI report, FOMC meeting date, major tech earnings, geopolitical summits, US election primaries, set alerts. These events will be make or break moments. Alalits, final thoughts, plups. Call to action. The market is a living thing, driven by fear, greed, and human psychology. Right now, all three are about to collide. Whether it's a boom or a bust, an opportunity is coming. Will you be ready? If you learned something new, hit that like button. It really helps the channel. Subscribe and turn on notifications because I'll be covering these events in real time. Drop a comment. Are you bullish or bearish right now? I want to know. Until next time, stay sharp, stay smart, and stay invested.